In 2023, the global private equity industry was hammered by rising interest rates. Borrowing costs jumped by 525 basis points from March 2022 to July 2023. This was the sharpest monetary tightening in decades. In response, the number of investments, exits, and buyout fund closings all extended the downward slide that had begun in 2021. Buyout deal value around the world has tumbled by 60% over 2 years, falling to about $440 billion in the steepest drop since the global financial crisis. Against 2021, deal count was down 35%, exits value declined by 2/3, whilst count of funds closed dropped by 55%. The exit conundrum has emerged as the most pressing problem for general partners, pressuring them to find creative ways to create liquidity for their investors. With funds now sitting on an aging $3.2 trillion of unsold assets, accounted for by some 28,000 companies, staying still is not an option. Zooming in on Europe, we see that the value of investments and exits continued their slide from 2021 levels. While the number of fundraisings fell, the value was supported by a few large deals. Buyout deal activity slumped by about 46%, making 2023 the slowest year since 2016. Buyout deal count was down or muted across all regions and deal size segments. Taking a step back from 2023, we can't forget that private capital has seen huge growth over the past decade, with assets under management more than tripling to $14.5 trillion by Q2 2023, with buyout accounting for a stunning $4.5 trillion. And despite the challenging market environment, limited partners continue to still largely be bullish on this asset class. Signals of the private equity market recovery already surfaced, driven by the expectation of decreasing interest rates in the coming year, but also given the fact that there is record buyout dry powder volume of $1.2 trillion out there, 1/4 of which is 4 years old or older. In Europe, dry powder available for deals reached about $120 billion, which is 18% higher than the 5-year average. Overall, nearly half of all global buyout companies have been held for at least 4 years. Now, in short, all of this is saying that the conditions appear to be shifting in favor of hitting the go button. We will see what 2024 brings. In response to this challenging environment, leading GPs are on the front foot to adapt their buy-to-build strategies, harness the power of generative AI alongside the investment cycle, and find creative solutions to generate liquidity for their investors, including secondaries or continuation vehicles. With the market encouraging multiple arbitrages, buy and build has historically become one of the most popular strategies. Buy and build has been fueled by the practice of building a company with high valuation multiple by using a well-positioned platform business to which smaller businesses bought at lower valuation multiples can be bolted on. But higher interest rates have disrupted this historically virtuous bigger's bigger scenario. Multiple arbitrage is now much harder, so private equity firms will need to double down on securing growth and stronger margins for organic value creation. As in every other industry, generative AI is changing the game for private equity, with implications at every level of the value chain. Industry leaders are already using this technology to scan portfolios, rethink how they conduct due diligence, and investigate how they can improve decision-making and boost returns. But also, private equity firms will need to assess another game-changing dimension of AI by looking at how portfolio companies may be affected by the technology and understand whether these businesses can lead innovation in the use of AI or will actually see their activities disrupted by it. Another implication of the liquidity crunch is that secondary funds grew faster than any other asset class in 2023, raising 92% more capital. They offer GPs and LPs tools to manage their own liquidity needs and those of their stakeholders. Of course, despite their phenomenal growth, secondaries transaction volume of $120 billion in 2023 is still a tiny fraction of overall alternatives AUM, which stands at around $20 trillion in 2023. However, there is multiple reasons to believe that they will eventually scale. So, overall, the outlook is positive. But breaking up the current logjam will require new approaches to value creation and a programmatic portfolio management plan to generate near-term exits and getting capital back to investors.